First, we'll cover the thin borderline. Second, the 5 rules of classification. Third, we'll dive into solving expenditure scenarios. Fourth, we'll look at capital versus revenue receipts. And finally, the final tally to bring it all together.
All right, part 1, the thin borderline. So, to really understand the core theoretical difference here, we have to look closely at the time factor and the matching principle. See, capital expenditure builds the foundation of a business. It generates these enduring, long-term benefits that stretch over more than one accounting period. Because of that, it gets neatly parked on the asset side of the balance sheet. Revenue expenditure, on the other hand, is basically the cost of keeping the lights on, running the day-to-day operations. Its benefits expire within the exact same accounting period, so it hits the profit and loss account immediately. And the matching principle dictates that we absolutely must match these revenue expenses against the revenue generated in that specific period.
Moving right along to part 2, the 5 rules of classification. Now, in the real world, the line between capital and revenue gets incredibly blurry, so accountants rely on these 5 diagnostic clues as a sort of mental checklist. First up is the nature of the business. Basically, what you sell dictates how you classify what you buy. Second is the recurring nature. If you're paying for it every single month, like rent, it's probably revenue. But if it's a rare, massive purchase, it leans heavily toward capital. Third and fourth are the purpose and the effect on revenue-generating capacity. And finally, number 5 is materiality, meaning the relative size of the amount involved can actually sway your decision.
The really crucial distinction here is enhancement versus maintenance. When you're looking at the purpose and effect of an expense, you have to ask yourself, does this expenditure actually increase the productive capacity or maybe reduce the future costs of the business? If the answer is yes, it's an enhancement, and therefore it's capital. But does it merely maintain the existing earning capacity? If you're just keeping things running as they already are, well, that's just maintenance, which makes it a revenue expenditure.
Okay, part 3. Solving expenditure scenarios. Let's put this into practice. Time to put the theory to the test. I want you to play detective with me here for a second. Think about your prediction before I reveal the answer. Here's our first case. Best Tech Solutions is in the business of buying and selling computers. They buy 20 computers to sell to their customers, and they buy 1 computer for their own accountant to use for invoicing. So, applying the nature of business rule, how would you classify these 2 purchases?
If you guessed revenue for the 20 and capital for the 1, you nailed it. This brilliantly illustrates the nature of business rule. Because Best Tech Solutions is literally a computer retailer, those 20 computers are just normal inventory stock for them. That makes their purchase a straightforward revenue expenditure. But what about that 1 computer for the accountant? Well, that one isn't for resale. It provides a long-term operational capability for the business itself to function over several years. So that makes it a capital expenditure. It's the exact same physical object, but entirely different classifications based on the nature of the business.
All right, let's try another one. This time we're testing the enhancement versus maintenance rule. Imagine a business spends $25,000 overhauling a car engine specifically to achieve better fuel efficiency. Now compare that to a business that simply replaces a worn-out ring or a piston just to get their car running again. What is the verdict here?
The overhaul for better fuel efficiency is absolutely a capital expenditure. Why? Because improving fuel efficiency actively reduces future running costs, giving the business an enduring long-term advantage. It enhances the asset. But replacing a worn-out part, you're really just doing routine maintenance to keep the car at its current baseline capacity. So that replacement cost is purely a revenue expenditure.
Let's throw a bit of a curveball your way with some intangible costs. Good Pictures LT is building a cinema. They incur legal fees to acquire the property, and they also pay out to obtain a license just to run the cinema. Are these capital or revenue expenses?
They are both capital. These are what we call pre-operative expenses. The critical detail to remember here is that the money is being spent to acquire the fundamental right to carry on the business or to possess ownership of the property. Without that license, the cinema hall literally cannot operate. Therefore, the cost of obtaining that initial license is capitalized. As a quick side note though, if you're paying a lawyer to defend a lawsuit against a property you already own, that's just maintaining your existing rights, which would be classified as revenue.
Sticking with Good Pictures Ltd. for a moment, here is a really fascinating one. During the construction of the cinema hall, they spend money building temporary huts to store their building materials. As soon as the cinema is finished, those huts are entirely demolished. So, capital or revenue?
Surprisingly to a lot of people, this is actually a capital expenditure. Even though the huts themselves are completely temporary and short-lived, constructing them was incidental and absolutely necessary to build the main fixed asset, the cinema hall itself. Because of that, the cost of those demolished huts is actually added right into the total capitalized cost of the cinema building.
Which brings us to Part 4, Capital versus Revenue Receipts. Now, let's flip the script and apply the exact same reasoning to money coming into the business. Just like expenditures, receipts have to be carefully categorized. Revenue receipts are the lifeblood of your normal business activities. We're talking about cash sales from your inventory or interest income from your bank. Capital receipts, on the other hand, are non-recurring and not revenue in nature. This includes cash brought in from selling a fixed asset, securing a new loan, or capital contributions from the business owners.
Let's test this out with a quick illustration involving a company called AB Limited. They have a machine sitting on the books with a value of 10 lakh, and they sell it for 12 lakh. How exactly do we categorize this sudden influx of cash?
Well, that entire 12 lakh is classified as a capital receipt. It stems directly from the sale of a fixed asset, which is completely separate from the everyday revenue of selling regular goods. The accounting books will then separately recognize a 2 lakh profit on the sale of that machine. Doing it this way ensures that selling off the company's foundational assets doesn't artificially inflate the reported daily operating revenue.
And finally, Part 5, the final tally. Let's bring all this together.
We've definitely covered a lot of ground in this explainer today. So, to consolidate our diagnostic toolkit, when you're evaluating an expenditure, always look at the period of benefit. Is it long-term, crossing over into future years, or does it expire right now, in the current period? Look at the purpose. Are you actively enhancing and increasing capacity, or are you simply maintaining what you already have? Buying a car or doing an efficiency overhaul is capital. Paying for routine repairs and staff salaries is revenue.
Before we wrap up, I want to leave you with something to really chew on. Imagine if you mistakenly classify a massive, multi-million-dollar capital enhancement as a simple revenue repair. You would end up subtracting that huge expense directly from this year's profit and loss account. You could take a highly profitable company and make it look like it's absolutely bleeding money on paper, completely distorting its financial health to investors. That is exactly why mastering this thin borderline isn't just dry accounting trivia, it's literally the foundation of financial truth. Thanks for joining me on this explainer, and keep questioning the numbers.